Hi everyone, and welcome to this week's macro outlook. And this is followed in a second YouTube post that I do on some technical analysis. So I hope you enjoy. Okay, so last week we saw plenty of action and opportunities. We had FOMC and obviously the employment data released. Uh, Indices and some stocks made record highs, although, if you look back at the small caps and you can see them in the Russell 2000, they still continue to lag behind. And that's because the Titans, this Magnificent Seven, etc., are the ones that are really pushing these indices rather than anything else. And of course, some of them had mixed earnings themselves. We saw Apple and Google disappointing, while Meta stock value rose over 200 billion, and that's a record rise. And on top of that, then we had Amazon, which posted really strong results. Bezos is reported to be looking to sell up to 50 million of his shares. And the S&P just failed to hit the 5,000 mark. Okay, so Powell finally killed off any expectations of a March rate cut, and of course that saw yields start to rise again, taking the shine off of gold and silver. Uh, Crude traded mostly lower during the week, finishing pretty much near the lows after it broke $72. It did have a slight bounce Friday, just a little bit of short covering, I would say. And this oil could move a bit higher on the opening due to those 85 missiles fired by the US and the threat of more to come in retaliation for that attack which killed 3 Americans on the Jordanian border last week. Biden had promised that there would be consequences. I suppose now the question is, will this escalate matters in the Red Sea and elsewhere even more? Interestingly enough, over I think it's about the last 20 years or so, Trump is the only president actually not to start a war somewhere, or at least get involved in it. He did his economically rather than anything else. Okay, so if we look at that, geopolitical issues, they could disrupt supplies, they could increase transport costs, they could delay deliveries as ships avoid those volatile shortcuts. And of course, that will increase costs and that could give a little boost to inflation. But of course, as we look, how many times can I say this? I've been a massive fan of the US economy for years now. And, it still continues to surprise most with the strength that the economy is showing in the data. NFP was a huge beat to the upside. However, I warned last month that this is likely to carry on. It's going to be March in my mind before we start to see the true employment conditions in the US, because obviously you've got all that seasonal high, and you had Thanksgiving, Christmas, sales, so lots of part-time staff taken on. But as those seasonal hirings drop out of the data, that's likely to give us a much clearer picture. And even so, I think that current data could be a little bit misleading at the moment, because most of the new jobs that are being created are part-time and mainly in the health and education sectors. Hourly earnings, yep, that was higher than expected. That came in at 0.6 month on month and 4.5 year on year, which again, just goes to show that there's still pressures there. Although, it's going to be very difficult to ask for big pay rises when inflation is at 2% or possibly even a little bit lower at some stage this year. Geopolitics allowing, of course. And although hours work continue to shrink, again, that's impacted by this part-time employment. And the rate of 34.1 is low, and it practically hints at contraction. Although I still, at the moment, just don't see that. Now, I've always maintained it would be sort of June before the first Fed cut, and I still think probably May, June is going to be right for that. And again, inflation could just have that spike due to all these geopolitical issues that we're starting to see. And that could, if inflation does spike, that could push any rate cuts even further into 2024. But and for me, I'm going to stick to 3 25-point basis cuts for 2024. This again, everyone's getting excited and going for bigger cuts, more cuts, and all that. But I just don't see it myself. But just remember, just my personal view. And of course, the Bank of England pretty much came out the same. They suggested rate cuts are not on the horizon yet. Now, again, going back to last year, I thought maybe they could have been second to cut after the ECB. But again, conditions aren't quite right for them. If central banks start cutting too early, that could boost inflation. And that's a bigger risk than cutting later, even if it does increase the potential of triggering a recession. When you look at the central banks, their credibility is already fragile, I would say. And then, of course, banks themselves have generally performed well. But is that really a surprise? They've been paying low rates to savers, yet charging much higher rates to borrowers. So, real pure banking. Although that said, the trading side of most of the banks has done pretty good in sort of, well, actually some of them great performances, especially if you look at JP Morgan's and such. Now, for more traditional banks, this could change soon, as they are going to be vulnerable to loans at sort of household level, corporate levels, and as well as commercial real estate. Now, that could lead them to keep tighter lending conditions for longer. And of course that doesn't include government debt levels, which are a major concern. And this is one of the things that's likely to take centre stage once inflation settles. There has to be a time when governments start to rein in debt levels, or at least risk being downgraded. And any austerity will only cut debt so much. And of course, what we've got to remember is it's election year in so many countries this year. So they're going to have to be brave to do that. And of course, that only leaves higher taxes. And of course, in election year, are they likely to do that even? So, of course, when it comes to sort of paying all this debt, the burden falls on the 99%. Because that elite 1% continue to abuse the system, as do all the major corporations, really, all the international ones for sure. In my mind, earnings should be taxed in the country they're produced, and at that country's rate of tax as well, not moved to countries like Ireland and others where they offer reduced tax rates so that they get that benefit. Then another warm winter in Europe so far, sort of keeping gas reserves high. France now has all its nuclear energy industry back to full strength as well. So again, that's keeping sort of price pressures on, sort of energy sectors, holding them down, which is a good thing. Of course, again, in some countries there could be that slight spike on inflation just where some of these energy subsidies are removed, and then it's left much more to what's going on in the markets. But gas especially is sort of it's bought ahead of time. It has to be. So those higher prices might still be charged because the lower prices haven't been bought yet, or if they have, they're not sort of being introduced yet. So it's a bit of a mixed one, that, but it's always a problem. When gas prices are higher at wholesale level, then we get charged that very quickly. When they drop, these companies seem very slow to pass on any savings. Yeah, good old off-gem or whatever it's called. So if you need to keep ahead with the latest news as it breaks, then I suggest that you try one of our partners, Financial Juice, there is a link available, so that, you know, if there is any fresh news coming out as it breaks, you're going to be one of the first to hear it, and then you can react to that. So that's all I'm going to say this week. I wish you the very best of luck with your trading. A couple more slides about services, etc., and of course our disclaimer. And then I'm going to be moving on to some technical analysis, looking at some of the day charts in preparation for what's ahead of us in this coming week. But now I just want to sort of just talk a little bit here about my services that I offer. So there's a daily newsletter that includes global news, headlines, my views, full articles. That is a subscription service. There's one-day workshops. You know, this will help you to discover if trading could be your next career or even just a second income. Otherwise, you know, maybe you're already trading, but you know, there's a few gaps that you'd like to fill in, and I can help you with that, because that will accelerate your trading and your performance. And then there's a 1-week intensive course. You know, that's going to make you feel competent and confident after just 1 week. It's going to give you those foundations that you need to build your trading career on. And, you know, if you've got that inner trader, we'll find it. And now that does also include a free trading challenge. Then I do a Flexi Masterclass, which includes 6 weeks of guided learning. They can be split up. You know, you don't have to take them all at once. And this is designed to provide you with all the knowledge and trading tools that you're going to need to navigate any market, and also on any asset class. You know, I trade them all. And as I say, you know, you can spread those weeks out over months if you need to. It's no problem for me. And again, that does include a free trading challenge. Now, trader mentoring, I'm doing more and more of this. And, you know, this is to help you reach that next level time and again. And, you know, I'm doing much more in the way of one-on-one sessions right across everything that I'm doing now, rather than sort of looking for big groups. I do provide a lot of trader educational content to individuals, exchanges and brokers. And as you know, as I mentioned earlier about the trading challenges, you know, if you're looking for a funded trading account, then, you know, you can contact me for details just about the ones that I use, or, you know, you can sort of take one of the courses where I'll give it to you for free at the end of it. Okay, so then moving on to our disclaimer, just to make you aware that trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. And many companies provide leverage, so just be aware that you can lose substantially more than that initial investment. Everything I include in here is just purely for educational purposes. I'm not trying to encourage you to trade or invest. That must be your decision. And of course, you know, before you make that decision, you've got to consider the risks involved, definitely your financial situation, your level of experience, and your risk appetite. And of course, it's important that you only risk capital that you're prepared, but also that you can afford to lose. And if you've got any doubts whatsoever, seek independent financial advice, and do that before you risk your capital. So many people come and find me after they lost money, which is sad. You know, they should come to me before. And yeah, so listen, that's it for part 1. I hope to see you in part 2, where I'm going to do some technical analysis.